Hello, welcome back to Hurdle Rate. For this video, we're going to build a DCF from scratch for Pepsi. So as you can see on the graph, after the recent earnings report, the stock price really broke out from this range that it had been doing over the last year or so. So what we're going to do is we're going to pull up the financial statements and we're going to dive into the numbers to see what the intrinsic value of the company is. So first things first, open up your spreadsheet, go to the SEC website, search for the ticker PepsiCo. The ticker is PEP. The filing category, go annual, quarterly, and current reports. And it should be the first one. Open this 10K up. Once you're on that, once that's open, come to page 65, and this will give us a breakdown of each revenue segment for the company. So as you can see here, we've got Pepsi Foods for North America, Pepsi Beverage for North America, the international, I think it's the bottling service for Pepsi. Then you have the Europe, Middle East, and Africa, LATAM, and APAC. So let's dive into those and see what it comes up with. So first things first, on your spreadsheet, go to page layout. So I'm actually using Excel on the browser at the moment. My desktop version isn't working for some reason. So you have to go View, remove your grid lines, freeze panes. Let's freeze the first column. As always, we insert another column. We go, so make your A column smaller and your B column larger. And in the cell A1, put the ticker, which is PEP. We want ticker here, date. The shortcuts are a bit different on the browser version, so it's going to be a lot slower than usual, and I haven't quite worked them out. So please bear with me there. Order. I think the fill is go home, we go here. Ticker equals A1 dot. Oh, I haven't put the data in yet, sorry. Types, stocks. It's this one on the NASDAQ. The date today is the 15th of February, 26. The current price equals A1 dot price. The implied, and this one we can leave for now. The first section we're going to do, if this is your first time following, we're going to do the first section will be the assumption. Just put this into sort of a navy blue. White so that it's readable. Then the first year that we're going to start is 2023. So you go 2023. We will go to 2031. I can zoom in slightly. Go. We go sorry. And the revenue segments are just going to be these here. So PFNA, Pepsi Foods North America, PBNA, IB Franchise, EMEA, LATAM, Foods, Asia, Pacific. And these will make sense once we build out the first one. I'll show you how to do that when we get to it. But for now, let's not worry. In your switches, just put 2. That leaves it on the base switch. EBIT, WACC, which is the terminal growth value. Copy these 2 down here. Then leave these 2 blank for now, because they're going to basically be whichever switch we select from here, and it will display here. Sorry, the assumptions bit should not be like that. It doesn't need the years there, we need that down here. Revenue build. I'll just delete what I've written up here. So revenue build, we put equal to B10, or whatever it is on yours. Percentage growth. This one might take a little while to do, but we'll eventually just start copy and pasting and fill in the correct numbers. It doesn't let us show negative numbers in the parentheses. Strange. Okay, so for 2023, Pepsi Foods North America, the revenue was 28. So this is 28 billion, but we're going to be displaying it with just this will be denoted in millions. So we just need to put it at 28,050. For 2024, it was decreased to 7,431, 27528 for 2025. Actually, we don't need this one either, because we have the full year results. It's not like we have partial from the 10Q. We'll put maybe it comes back to 1% growth. Then can we do 2 decimal? We'll put okay. Now, to work out what is going to go on here, we say equals, you take the previous year minus, open your brackets, your previous year minus your final year, close brackets, divided by, take your final year and subtract the next year from now, and close brackets. Then what we want to do is we need to lock in a few of these here. So if we're working backwards, the row will always be the same, but this column will be different. This one will always be the same. Then for this one, the column will always be the same, but not the row. Then that's it. There we go. Well, actually, let's say this is going to go a bit, it will be a bit better. It's probably not going to be, let's say there's a 0.5% growth next year instead. So the bear case is going to be 95% of this 1%, and the bull case is it will be 105% of the 1%. Make sure to log this in. Do the same here, and it needs to be IN. Equals offset. We select the cell that we're in, F27, the switch, put a 0 afterwards, and lock in pull it along, do the format again. Go. Now to work out the revenue growth, you just take the previous year multiplied by 1 plus the percentage growth, pull it along, and then there we have it. So that's the first segment done. So equals 11. So for 2023, it was 27626. Two seven seven 9 28197. Say this is 1.5. We just need to change these to the correct switch. In this case, it's on row 11. There we go. B12. 4559. 4879. 4997. let's say this does go up to, we'll put 5% here. Well, we have 3 segments left to do. Sixteen 0, 16 658, 18 025, everything to the appropriate row. A47. Again, we can put 5% for the Europe, Middle East, and Africa. And it does seem to be, yeah, it does seem that the Europe, Middle East, and Africa, LATAM, and APAC are outpacing the North America growth-wise. And 576, and 568. And actually, no, LATAM looks fairly flat. Maybe let's put up a 0.5% growth. So what we're going to have to do here is we put this equal to I14. This one equal to E14. And the rest we keep as they are. It's just that when it's a negative number, you have to reverse the bull and bear. So that's fine. Yeah, that looks. I'll show you quickly just how the switches work. So let's do for North America. So this is the base case. Just remember this last figure, 28,576. If we go bearish, we see it comes down a bit. If we go bullish, it comes up. And we can play with all of them depending on how we think they're going to perform over the next, or over the duration that we're projecting. 15 APAC. Okay, we're on the last one now. 4485. 549. 4629. It really looks like the growth is coming from is really Europe, Middle East, and Africa. Let's put this, let's say long term, it's a 2%. order. Yeah, I've got the full 6 there. All this there. Let's actually put these a bit higher because the forecast going forward for is that it will be 3 to 4% revenue growth. So maybe we can put this to 1.75. Yeah, I think that's and we'll give 1%. We go 2.2 here and we go 2 here. Yeah, I think that's a bit better. The next section is the income statement. We take revenue, let's put it equal to what we have here, pull it along. The next line is the EBIT, percentage of revenue. Taxes, we want to know what it is as a percent EBIT. I'm just copying this down just because I want to keep it formatted. Up to the income statement, which is on page 57. We want this one, operating profit. 7,986, 12,887, 11,498. Pull this up to 2026, then we just take the average of the years long, take your revenue and just multiply it by percentage. Go. For taxes, we use this provision for income tax. And I'm just going 2262, 2320, 1949. Oh no, sorry, I've done something silly. It's, what was it? 2262. Okay, this is the income statement. This is sort of just a placeholder, this EBIT. You'll see when we do the proper one when we get to the DCF section. The next section are the cash flow items, and they are this page, which is 59. We want depreciation and amortization. This is our change in net working capital, and we just sum all of these. Then CapEx, we want this one here. Capital spending. Usually it's called purchases of property, plant, and equipment. Let's use this one. So, A, you want to know what this is as a percentage of revenue. So because you can't just copy the formatting on the browser version because it opens up the console, I'm having to copy it down like this and then just edit the numbers. One. CapEx down here, 5518. 5318, 4415. Again, we want as a percent of revenue. For this one, we just take the DNA divided by the CapEx. Okay. So it's just the sum of these equals sum. Negative 793, negative 261, negative 30, 420, 0, 18. Negative 138, negative 314, 40, negative 3, it doesn't let us do it in brackets. Keep it like this. It's not as aesthetically pleasing, but negative 580, negative 10, negative 7, negative 3, 7, 1. Okay, those are the cash flow items. Let's move on to the actual DCF now, and this will get us to the unlevered free cash flow. Go through everything again, but it's fine because we just copy paste. We need to do a switch for the EBIT. Put our EBIT equal to what we have here. We want to know what this is as a percentage of revenue. And we'll say that this, let's say it goes up to 14.5% on their EBIT, because they are saying that they want to do, that they are projecting EBIT expansion. I-70, sorry. We have to change this formula to revenue multiplied by, this is the EBIT margin, but this should be percentage of revenue. So pull that along. Go. Make sure this one is linked to this, because when we flick through the switches, the projected tax paid is going to fluctuate. Okay. Now, order. We're calculating the EBIT, which is the earnings before interest but after tax. And this is simply, you take your EBIT and you subtract the taxes. Now you bring back in your cash flow items, D&A, CapEx, change in net working capital, there we go, CapEx. Again, just copy this border down. Now we have our unlevered free And all that is you take your EBIT, you add back in depreciation and amortization, you subtract your capex, and you subtract your change in net working capital. Something's not right here. And wrong. This needs to be revenue. It's definitely not 14%. Okay, yeah, this makes more sense now. Yeah. Yeah, okay, that looks okay. The next step is to find the present value of unlevered free cash flow. And for that, we need to build a WACC. So come on to another sheet. You red line. Don't need to freeze any panes, but just make your A smaller, your B larger, F. And we're going to calculate the WACC a bit as well. So your WACC is your weighted average cost of capital, and it equals your percentage of equity multiplied by your cost of equity plus your percentage of debt multiplied by your cost of debt multiplied by 1 minus the tax rate. So what we need for this is we need the market cap data. We need market cap, we need percentage of equity, cost of equity. And what the cost of equity consists of, it's the risk-free rate plus your beta multiplied by your equity risk premium. Gently, slightly. The next bit is the debt, percentage of debt, cost of debt, tax rate, total, and we have the WACC. Okay, so the market cap's easy. We just go equals A1.market divide by 1 million. So we're formatted correctly. So Pepsi's about a 226, nearly $227 billion company. We can't, well, we can, but we'll leave the cost of equity for a second. Percentage of equity and percentage of debt is what we're going to calculate first. But to get the debt, we go on the balance sheet, which is here. And what we're looking for are, so your short-term debt obligation, 6861, and the long-term debt obligation, 4231. And we should be looking at just anything on here that is interest-bearing debt will treat as debt. So the total is 275,964. The percentage of equity then is your market cap divided by your total. This into percentage. Same with the debt. Go. The cost of equity, we go and we find the US 10-year, which at the moment is 4.0520. 4.0520%. The beta, which we can calculate as so, we're going to use the beta for the industries that we think Pepsi operates in. The first one is beverage soft drink. And then we would go food wholesaler, probably. And then food processing might be the bottling. We'll do that. So 3 different industries we'll look at. So go industry. We're saying beverage, soft, food processing, food wholesale. We want to know what the unlevered data for these are. Then we want to know the revenues. Then the EV to sales, which will give us the value. Then we get the weight, get the weighted. So the unlevered beta number, and we need it to 2 decimal places. So for beverage soft, 0.59. Food processing, 0.67, and then 0.68. Wait 1 second. 0.67, 0.68. So let's just have a quick look at, if we take for North America, they're fairly equal. So we'll say the same for Europe, Middle East, and Africa, for LATAM and Asia Pacific, that half of these are going to be the food side and half will be the beverage. So for the beverage soft, we're going to go equals beverage plus, do this one, divided by 2. Make sure to bracket, plus LATAM divided by 2 plus APAC divided by 2. So food processing we'll just put as the beveraging, the bottling. And the food wholesale is going to be this one, PFNA plus divided by 2 plus LATAM divided by 2 yeah, that's good. Then for the EV to sales, we go into the price of sales spreadsheet and we want this column here. So beverage soft, EV to sales is 3.48. Food processing, $1.34. Food wholesale, 0.41. We put the value as you take the revenues and you multiply it by the EV to sales. And the weight, lock in this last one. Pull it down. We'll just put it to, we'll go 2 decimal. And then to get the weighted beta, you just take your unlevered beta, multiply it by your weight. Go. So 0.6 each 20. Now the equity risk premium is a similar process. We need to go region, revenues, ERP, weighted ERP. So the first region we're going to go is North America. Then we have, let's break it up. Okay, so North America, then we'll go Europe, Middle East, and Africa, LATAM, and then APAC. And then for the bottling, I think we can just use the global one for that, and we'll so back to here we go sum. Europe, Middle East, and Africa. LATAM. APAC. The global one we'll just put as this bottling. So the ERP, we go onto the country premium spreadsheet, the risk premium. So North America, we know is 4.45%. Europe, Middle East, and Africa, 5.91. LATAM, we'll go Central and South America as, and we'll say 8.46. There's another. Yeah, let's do that, 8.46. Then APAC, Asia Pacific. We'll go, 5.72, 5.72. And the global one is, where is it? 5.63. It's a bit bigger now. No, because I click from the balance sheet later. But here, the weight is you take your revenues divided by the total, lock in the total. Take your ERP and you multiply it by the weight into a percentage. Down. Sum. There you have it, 5.31%, F40. Okay, the cost of debt, we need to go on to the income statement. We go. We just need to know what the interest expense was. So 1121, and we divided by the debt. We go 2.2793%. Yeah, that's fine. Then the tax rate, actually just went past it, come up a bit. So 19%. So now we just do this formula and we'll get the WACC. Just make sure it is so equals, open your brackets. Oh, sorry, we haven't calculated the cost of equity. Your cost of equity equals your risk-free rate plus your beta times your equity risk premium, 7.25. So now for the WACC, we open brackets, we take our percentage of equity multiplied by the cost of equity, close brackets, open brackets again, take your percentage of debt multiplied by your cost of debt multiplied by 1 minus your tax rate, close brackets. There we have it, 6.28% for the WACC. So we come back onto our main spreadsheet, we take the WACC and we put it equal to what we've just calculated for this cell. A bullish WACC, we're going to subtract 0.5%. And for the bearish WACC, we're going to add 0.5. The terminal growth value we're going to set at 3%. Bullish, we're going to say we're going to add 0.5%. Bearish, we're going to subtract 0.5%. Now, to be able to use the switches on the WACC, we just go equals, choose, and you just select all of these in order. Go. Okay, now come back down to here. Above, just insert another row. And above 2026, put 0.5. Then after that, 0.5 plus 1. And these are our mid-year conventions. because we're saying that Pepsi, it generates its cash flows throughout the year rather than all at the end of the year. So we're going to take the midpoint to discount back. So you work out the present value of unlevered free cash flow now. We take our unlevered free cash flow, divide by 1 plus the WACC, close brackets, to the power of the mid-year convention that we put here. Oops, sorry, I forgot to lock the WACC in. There we go, that's better. The next calculation is the terminal value, and that is just your unlevered free cash flow multiplied by 1 plus your growth rate, terminal growth value, close bracket, divided by your WACC minus your terminal growth value. The number. Oh, it's made the column larger. And we want the present value of the terminal value. And that equals your terminal value divided by 1 plus your WACC to the power of that final year. Okay. This takes us on to the enterprise value. You go equals sum. There we go. Now we want to add our cash back in and subtract our debt to get the equity value. And we know the cash is on the balance sheet. Here we are. They have 9159 in cash. We know the debt because we've just worked it out. It's there. Equity value now is you take your enterprise value, you add back in your cash, subtract your debt. This gives us about 444 billion. On the diluted shares outstanding, so we need to go back onto the income statement to give us an implied share price. So the diluted shares outstanding are, yeah, 1373. And you take your equity value, divide by your diluted shares outstanding, and we get an implied share price of $323. So J26 with J16, then the upside suggests that if these figures are correct, which they're obviously not correct, as we've sort of made them up as we go along, but if they were correct, it would suggest a 95%, nearly a doubling of the share price from here. So I think what you need to do is play around with the numbers, read about what Pepsi is forecasting over the coming years, and seeing, I guess, how realistic that is. Maybe we've gone a bit aggressive on the EBIT margin, but they are saying they want to increase it, but let's just put it down to 14. Well, we still get a very high, a much higher price. The bearish, what would that say? 222. So yeah, I mean, it could be a good option, but remember, this is not financial advice. So yeah, thank you for watching, and I'll see you on the next one. And apologies for being slow with Excel. The browser version is nowhere near as good as the desktop. So yeah, I'll get that fixed, and I'll see you on the next one. Please don't forget to subscribe, and yeah, send over suggestions of companies that you would like to see us value. Thanks. Bye.